So we're just adding trillions on top of what's quickly developing into a commercial bank dumpster fire here in the US. And this is starting to spiral pretty quickly.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hi there, my name is Shane Moran, and as you can see, I'm out of the vault today and in Costa Rica paradise for this week's episode of Live from the Vault. So welcome to the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We have exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Now, this week, we have the one and only Andrew Maguire, precious metals expert and whistleblower in the vault. And to help him pull back the curtain, we'll be joined shortly by popular demand by you, our Live from the Vault community, Robert Kientz, president of Gold, Silver Pros. That's right, Robert Kientz is in the vault, and you're not going to want to miss this conversation. So just before we get started here, please help spread the word about this channel and hitting that like button, sharing this information, and make sure you subscribe if you haven't already done so. And if you want to be notified in real time as each episode goes live, just click on that bell right there and we'll do that. So with that, let me tell you a little about Robert Kientz if you haven't already met him. He's the editor and publisher of goldsilverpros.com. It's an online show and podcast emphasizing the long-term cycle investing in the precious metals markets. Now, Rob is also the author of the 2010 book called Drop Shadow, The Truth About the Economy, and his work has been featured on Yahoo, Finance, MarketWatch, NASDQ, NASDAQ.com, also Seeking Alpha, and many, many, many others. And with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our special guest today, Robert Kientz. Over to you, Andy.
Well, guys, this is absolute pleasure. This is a friend. And as my wife just said, who's coming on? I said, my friend, he's a Texan. He's a rootin', tootin', shootin' Texan, and he loves gold. She said, oh, bring him on, bring him on. So nice to see you, Rob. It's been a while since we've had you on here, and I'm looking forward to joining you in a little while as well on your platform, your great platform. So really, I'm going to start by asking you, hey, what are you seeing on your side of the pond? There's a lot going on. And, start with what you think is the most important drivers at the moment. Obviously related to gold, silver as well. But what's going on? What are you seeing?
Well, I think what we're seeing and what's not necessarily being reported in the press, because to be honest, the financial press here in the U.S. is behind the eight ball when it comes to underlying fundamentals. They tend to take sort of the rosy approach on everything until something bad happens. With all due respect to them, it's really up to us in the alternative sphere, alternative media, social media, to basically point out problems as they happen. We had some bank failures here in the U.S. in the spring. I'm sure everybody around the world knows that we had First Republic and Silvergate, SVB, and then, of course, across the pond, Credit Suisse was having its own set of issues. So the banking system kind of was highlighted this spring. But something a lot of people don't know is we've been having bank failures here in the U.S. at a record pace. So when you look at the data, a faster amount of small and medium bank closures here in the U.S. than we've ever had. And this dates back to the mortgage mess back in 2008, the tech crisis in 2000, earlier decades of savings alone, I believe, was in the 80s. So this is one of the fastest paces on records that the banks are having all sorts of issues. And I've been looking at the banks in terms of a liquidity perspective. Anybody that follows my channel the last couple of years, we did a big series on Basel requirements and how the BIS is trying to implement standards for the banking system, make it more solvent. And a lot of it has to do with liquidity ratios. How much free capital or good assets do you have compared to money that you have outstanding, and also taking into account things like bad debt. And if you look at those liquidity ratios for the large commercial banks in the U.S., it doesn't look too good. There are a couple more that have very high liquidity ratios, over 80%, like loan to value ratios, where they don't have a lot of free capital. And for those, I believe on average for the large commercial banks, the data that I got from S&P Global Intelligence was that they're about 78.8% highly levered. And even some of the assets on their books, there seems to be some questions about whether or not those are going to end up being good assets or not. And not only that, but slightly less than 50% of all deposits fall uninsured. So over 50%, I believe it's 51.1 of cash deposits, I should say, at the major commercial banks in the US are uninsured. So if you're banking at a major commercial bank in the United States, you've got a greater than 50% chance that your funds will not be covered in the event of a bank failure. Of course, earlier this spring, the Federal Reserve and the FDIC worked together to bail out the depositors of those institutions. What was less talked about was the investors, the bondholders, and the stockholders basically got zero or close to zero in those cases. So in order to ensure the depositors, they had to allow all the investors in that company to fail. So even though a lot of the depositors were made whole in those earlier bank failures, it adversely affected investors. And I don't think, Andrew, given the amount of banks right now that are in trouble and the amount of overall uninsured consumer deposits in these commercial banks, that if we have another banking crisis, which looks like it's coming to the United States, if we have another banking crisis, most people are going to lose their money if they're deposited at a big bank. And that's a really scary situation to be in.
Yeah. And I think what was interesting was, it wasn't bad enough that the US got downgraded by Fitch from AAA to AA plus. Then we got shortly followed by the Moody's downgrade of 10 banks, small, medium sized banks, but they also seem to indicate, in fact, I was listening to an analyst on Bloomberg, which I tend not to listen an awful lot to, but we're talking about, yeah, well, you know what, this is going to likely roll into the big banks, which is what you're talking about. And I mean, when you think about it, you just outlined. And you're a forensic guy. I mean, you have an audit background, so when you look at these numbers, you look at it, we take notice because it gives us an extra view. But when you think that, and you talk about, I mean, obviously the next shoe to drop, I think, the commercial real estate market is what seems to be the issue, with about 80% of all of those, of that is held by these small regional banks. So, I mean, this is what gets me. So you've got the Fed talking up, yeah, we're going to go higher for longer for stronger. Yeah. Okay. And so as long as the stock market rises, yeah, we're going to keep raising rates but I mean, didn't that cause the problem in the first place? The speed of these rate cuts? So what do you think? I mean, how imminent do you think this might be?
Well, it's interesting because what we've also seen at the same time, Andrew, is there were in the large commercial banks, there were about a little over 11 trillion in deposits from consumers, dating back to April 2022. In the last year and 2 or 3 months, almost $1 trillion has been taken out. Consumers are wising up and taking their money out. Now, they may be doing it to pay bills. There may be, reasons why they have to spend that money, but it's almost a tenth of all consumer deposits at large commercial banks has been pulled out in the last year. And one of the reasons why, going back to the Fed, when the Fed raises interest rates, that forces these commercial banks into a tough position. Because on one hand, they can charge higher rates for investment products. On the other, they must then put in higher rates to their consumers in terms of deposit returns, or else they're going to lose them. And what consumers are seeing is we're over 5% federal funds rate, which affects things like mortgages and auto loans, down the line. All that gets eventually passed down the line because when banks have a higher cost to borrow, they must pass on those costs to the consumers. Ultimately, the people that pay the price for a rise in the federal funds rate from the Fed are the consumers, ultimately. And what's happened is there's a big, what we call deposit gap. the banks can charge a lot for auto loans and home loans and credit card rates and revolving rates and all those types of things. The consumers are still sitting there getting 0 or 0.25% or a half if you're lucky. And as that deposit gap widens, history has shown the consumers simply pull their money out of the banks. Well, what does that do to the loan to value ratio of the banks, which I just said is too high? And by the way, if you look at what caused the issues for Silvergate and SVB and even Credit Suisse, it's that they had more bad stuff on the books compared to the good stuff. So whenever people take out their depositor funds, it reduces available liquid capital to the banks, and it causes them to go into a squeeze situation where they don't have enough money coming in to take care of what they have going out. So the banks cannot raise their CD rates or their money market rates or those type of short or medium term deposit rates or even like their bank account interest rates for consumer. They don't have the money. And just to fund operations, Andrew, the wholesale funding market, the amount of money that the banks are taking out of wholesale funding, which comes with a cost, it's not free, has been spiraling up about the last 6 to 7 months. So about the same time that consumers have been taking their money out, and about the same time that the liquidity ratios for the banks have become under stress, they're having to borrow money just for operations. And that money's not going back to consumers in the terms of interest-bearing accounts. And so when you take on an obligation, you borrow money from the wholesale funding market, nice for the wholesale funding market, not so good for the banks. They got to pay that back with interest. That creates another liability on their balance sheet, which means the loan to value ratios are going to go down. So it's like this nasty spiral. Unless the commercial banks can attract more deposits and or somehow sell off some of their loans and recoup that money, assuming they can, there's a big issue there. And I'm going to throw another thing onto the pile here. We've also been reporting that the student loan debt, which amounts to 1.5 trillion, that's trillion with a T, Andrew,
Wow.
has come under extreme fire in the United States. There is a report from Morgan Stanley Research. There was a letter written to loan servicer by 6 U.S. congressional senators, and research put out by the Consumer Financial Protection Bureau, which is a bureau of the government here in the U.S. aimed at protecting consumer rights and letting consumers know where there are problems. You put all that together, here's what's happened. When our current administration, the Biden administration, had promised people student loan forgiveness, one of the biggest servicers, Navient, just exited the market, said, okay, I mean, you're doing forgiveness, we're out, And a lot of the other services have changed position. Well, the Supreme Court in the United States said, well, you can't really do that by executive fiat. So that basically was reversed recently. The only thing that the current administration could do is use executive action to change payment terms and things like that within the scope of their powers, within the existing law around those student loans and the covenants around that debt. And they're trying to do that. The problem is you have two major issues. One, the students or former students are logging into their loan servicer portfolios or websites, and they don't know, A, who they're supposed to pay, and B, how much, and C, when. So the 6 senators wrote a letter to servicers saying, either you get this fixed or we're in serious trouble, because they're worried about scammers stepping in and saying, we own your student loans and the students will pay those back and the government will never get their money. They're also worried about a potential default because if the servicers can't service, because nobody knows who's the servicer and who's paying and what they're paying and when and how, that debt could go into basically like a default. But it gets worse, Andrew, because Morgan Stanley put out research that said 34% of all student loan borrowers cannot pay that debt back right now. If the government said, today's the day, we're now making them do, the forbearance is over 1/3 of those student loans cannot be paid back. In addition to that, almost an additional 37% said, we're going to have to stop spending on other areas of the economy. Well, guess what happens there, Andrew? According to research by both Morgan Stanley and the Consumer Financial Protection Bureau, one, that has raised delinquencies on all of their credit products, homes, autos, credit cards. That has already spiked, and we haven't even gotten to the end of the forbearance yet. And it's already spiking for those who have student loans. They're already defaulting on other debt before they even have a chance to default on their student loans. And in addition, Morgan Stanley Research, one of the largest commercial banks here in the United States, it certainly has a big research group, has basically stated, well, in addition, any company like outside of like the barest of minimum, dollar stores and Walmart, you're probably going to be okay. Target, Dick's Sporting Goods, Wayfair, anything that's above the base level retail outlet in the US looks to come under severe pressure, according to Morgan Stanley. Essentially, this is Morgan Stanley issuing a warning that if you're not the cheapest of the retailers, you're in trouble. And so that could cause corporate defaults in the retail sector, which is something we do not want in our economy right now. The second and third order effects of a default on student loan debt could really cause the banks, which are already in trouble, to get into serious trouble because, Andrew, who made the student loans? The banks, okay? The banks have that debt. So we're talking about potential for bad debt. They've already got liquidity issues. What if those debts go bad? That is a major issue. And not only that, but I'll be reporting on my channel pretty soon how there's also 1.5 trillion, that's with a T, of mortgage debt that's also coming under fire for similar reasons. So we're just adding trillions on top of what's quickly developing into a commercial bank dumpster fire here in the US. And this is starting to spiral pretty quickly, and the feds are really concerned, and they should be. This is a dangerous situation. Now, I don't want to blame the Fed for raising rates for all of this. This debt situation was going to come to a head anyway. To be honest with you, this is going to be coming to a head for a long time in the United States. The free money era from the Lehman crisis, 2008 to now, has blown up this massive bubble. It was going to come to a head. But the banking situation has gotten very, very dire, and there isn't enough money in the FDIC or any government insurance program to cover it, not even close. And we're talking about potential for multi-trillion-dollar failures in the loan market. That's a bad, bad situation here in the United States.
Rob, apart from what you just mentioned, that's not been on my radar at all. I had no idea what kind of what kind of issue this was. I mean, I in the past, I've given it some attention to see how's Biden going to forgive these student loans. And at one point, he was going to forgive them, wasn't he, or something?
He was.
So can it? But Rob, how can they get this so wrong? I mean, surely they have to. Is this actually by design part of trying to break the system so you can build back better? I mean, it almost seems like it's contrived. What's your thoughts here?
Well, politics is a funny thing. Politics in the United States has gotten to the point where common sense just does not matter anymore. We have to keep the system going because there's so many vested interests in the political system that none of those wants to give it up. And I don't think anybody in the political system really looks at the big picture. I think there's a failure in government at every level to look at the big picture. Certainly, there are a lot of vested interests that could capitalize on debt defaults, corporate failures. If you look at the big banks throughout history, if you look at the Great Depression, a lot of what happened during that was assets were priced on the cheap, and it was quote unquote blood in the streets. And what did the bankers say? You buy when there's blood in the streets. So it certainly benefits, the big banking families when there's blood in the streets. But the problem is when you have this type of situation, it's so dire, not all the banks are even going to survive. It would not surprise me at all if we had major, major bank failures. So I think largely what's going to happen, Andrew, is the small to mid-sized banks are going to fail for the most part, because if you look at loan to value ratios, I talked about the big commercial banks being in trouble. In the United States, according to the Federal Reserve's own database, Fred, the small commercial banks have higher loan to value ratios because they have less deposits, but more loans given. So the small to medium banks are going to go out first. And what you're going to see is a consolidation of banks into what I would call super bank. So you're going to see the formation of super banks in the US taking on this bad debt because the government doesn't have the money, and they're going to go begging to the banks, save us. What did they do during 2008? They went to the banks and begged them, handle this Lehman issue because otherwise our economy is going to collapse. So the political figures, for whatever reason, whether they're not smart enough or they just don't care, or they're focused on other things, whatever excuse you want to use, They don't understand the scope of the problem. The big banks do. The big banks are probably looking down at this situation going, yeah, we're about to get a lot bigger. And I'm sure that they're already thinking about the terms they're going to give to the U.S. government. The problem with the public debt, the national debt, is also under fire. U.S. Treasury rates have been rising. Everything shorter than a 2-year is over 5%. We've got a yield curve inversion, meaning you pay more to get a short-term bond, or the government has to pay more to get somebody to buy a short-term bond long-term. That is 100% of the time when that's happened in the last 100 years been an indicator of oncoming recession. So we're going to have a recession. We're going to have corporate defaults. There's going to be major issues. And, this is going to be across the spectrum. And I imagine the amount of anger that we saw in 2008 is going to be eclipsed by a factor of 10 when this next recession comes. People are going to be incredibly angry. And I think you're going to see just on the screen, you're going to see moms and dads losing their livelihoods. But what you're going to see is the political class realizing how big of a problem this is. The problem is for the last 50 or 60 years, the political class has stopped caring about the fiscal situation in the United States. Grow the military, grow the programs, promise benefits, it gets you elected. But you always have to pay the piper for that. And I think the U.S. at some point, United States government is going to default. And I don't say that lightly, but they're going to default. It's going to cause a crash in the dollar, and there's going to be a reordering of financial powers across the world, I think, when this is all said and done. And that doesn't benefit the political class. That's why I say I don't think it's all a grand conspiracy, because I think if a lot of the political class understood how their careers are about to end in infamy, I don't think a lot of them would do it. Now, are there people at the top that could benefit from this? Yeah, if they have financial interest, they could. And I think it may be a minority. I think the most people sitting in Congress don't have a darn clue, but I think they're about to find out. And I think a lot of their political careers are completely over when the next recession comes, because the anger that you're going to have from the people, 350 million people in the U.S., is going to be deafening. It's going to be unlike anything we probably have seen since the Great Depression.
My goodness me. I mean, this is mind-boggling stuff. And I think this is the value of, having yourself and people off the mainstream media, drawing attention, educating people into saying, hey, you know what? More fool us if we don't take notice of this. These are warnings. These are, and particularly coming from you as somebody who is a forensic analyst, and you see this, and you're looking at a huge picture here, and which is really helpful. But I mean, to me, I'm thinking, my goodness me, as you're talking here, I'm thinking, my God, that'll put. I mean, when you think that America was built on these little regional banks where a farmer would go to his local bank manager, he'd know his first name, deal would be done on a handshake, he'd get his new tractor, he'd get his funding for his crops and so on and so forth, build a factory or whatever. I mean, and so if they go out of business, as you say, there'll be mass. I mean, this is beyond anything that I think most people are comprehending. That obviously then you're talking about who's going to absorb that debt. I mean, as you say, it leaves maybe one or two super banks, and you kind of wonder if they're not rubbing their hands in glee, or whether this is by design. I'm beginning to think, how can this not be by design?
Well, ultimately it is, and I'll blame it more so than on, I mean, certainly the current banks understand the situation, but I blame it more on the creation of the Federal Reserve in 1913. And the reason Andrew Jackson as a president fought this, and why this was fought for so long, is that when you have a central bank and they issue money and eventually it gets to a pure fiat status, like in 1971 when Nixon took the U.S. off the gold standard, what you end up having is this fiat currency standard that has no checks and balances, and it ends up becoming a Ponzi and bankrupting the entire banking system. My parents grew up during the Great Depression. My mother's born in 1934, my father in 1924. My mother lived on a farm in the Great Depression, and when the Great Depression came, they almost starved, even though they were farmers, because they couldn't get fertilizer and things. I mean, they were living literally on beans and whatever else for years, and they lived in a little shack. But they counted themselves lucky because the people in the city were literally starving. And even though the government was rolling out soup lines and things, it wasn't enough. And people were surviving on half a penny a day. It got really bad. And this could even be a bit worse because back during the Great Depression, not as many people were highly indebted as they are now. More people lived in the country and had means to at least grow food or have animals. Now a much higher percentage live in the city. For example, I live in an apartment in the city. I don't have a farm outside my window. I have a concrete parking lot with a bunch of cars. And thankfully, my family's still in farming and ranching, and we've made some preparations in case this occurs to help each other out. But a lot of people aren't going to have that option. And it gets really tough on the people who will do things like eat rubber. And they'll boil the rubber soles of their shoes to try to extract. I mean, these are depressionary stories, and this is the type of thing that can happen. The reason I blame the Fed is because if you look at what caused the depression, it was a retraction in the money supply. Yeah, the roaring 20s. And, that was partly the fault of the banks and the people buying into it. Well, look at what we had since the last Lehman issue in 2008. People are borrowing money hand over fist and living beyond their means. But the banks have loaned that out. And now the Fed is restricting money supply. Well, I can show you by data that when they restrict the money supply, it causes banks to fail. Because, add 2 and 2 together. The banks don't have the liquidity. They've got high loan to value ratios. People have less liquidity. They have less money from jobs and things. They can't pay back their loans. It's a spiral. That's what happens. It's called a Ponzi, okay? And the government has instituted the biggest Ponzi in the world because we're the reserve currency of the world. And on top of that, what makes it worse is all the federal programs, all the federal spend is now so much higher. So that the national debt is so high. The national debt is sitting almost where it was after World War II. Now, after World War II, we had to issue debt to finance the war, but we also had the 50s and 60s, which was probably, the most prosperous time in America for single income families to live. I remember my dad worked at a coffee company and he could raise a family on that. By the time, he passed away and I was born in 1974, my mother was working 2 jobs to support 2 kids. The standard of living has changed. The ability to survive has changed. So I think this time with the Fed raising rates, and again, whether or not raising rates is good or bad, it doesn't matter because they were going to have to, because if they didn't, they were going to have hyperinflation. The only thing I think that staved off hyperinflation in 2020 was a pandemic. It was the partial closure of the American economy reduced the amount of upward pressure on the dollar. The dollar was in a panic state at that point. After that, it's taken us a while to get back on our feet. Well, we had really high inflation last year, and the amount of currency we have created and the amount of deficits the government is running now is astounding. I think we're like almost $34 trillion deficit in the United States. It's ridiculous. So the numbers have gotten so big. When it falls this time, it's going to be bigger than the Great Depression. There's more debt. There's less independence. There's less value in the currency that we have. And Andrew, not enough people own gold and silver. And gold and silver is the thing that gets you through these types of situations. If you have it, because all the governments will revalue back to gold. And you already have the Chinese and Russians doing this with their asset-backed digital currency backed by gold. And they've come out and made comments publicly that they're using gold, okay? And they're backing it with gold for a reason. I just did a report on my channel last night about how the World Gold Council issued a report, a survey of worldwide central banks. Worldwide central banks, over half of them believe that the US dollar is going to fall from foreign reserves from 59% where it's at the end of June this year to maybe 40 to 50%. What's going to happen when the dollar is no longer the predominant world reserve currency and you have these mix of other currencies? That's going to cause dollar value to fall. Okay, what made the dollar valuable? The petrodollar, international trade. The world central banks are saying the dollar era is over. It's over. And what are they buying to put into their coffers? Their biggest asset is cash. Andrew, they're not increasing cash. They're increasing gold. The central banks have said they don't believe in their own product. They're going to gold. It's clear in that World Gold Council report, a survey of the central banks. It's from the horse's mouth. They've already said the dollar's on its way out and we're going to gold. So I encourage everybody looking at this situation, to do what the central banks are doing. Because they're the largest, most powerful financial entities in the world. And if they're going to gold, that's probably a consideration everybody else should have as well.
Well, I mean, it all makes sense. And when you start to pull all the pieces together, and of course, what the World Gold Council is talking about is what is officially discussed. And of course, off-grid monetary gold never has to be discussed. You don't have to mention, you don't have to state that you're buying monetary gold. And we estimate that probably that between the Sino-Russia alliance, minimum has 4 times as much physical gold as the US Treasury, 8,133 tons, which is probably rehypothecated, massively rehypothecated. And then suddenly it all makes sense. You know what you're talking about. It begins to make sense because why did Fitch US downgrade US debt from AAA to AA plus? Why did they do that? And then, but the fools, because we all know that all central banks agree that from time to time they intervene in the foreign exchange crisis to manage their currency. So what do? Intervened. But what did they do to intervene? They sold gold to intervene. I mean, good God. I mean, when you think that as soon as we saw that intervention, we saw rates spike higher. We saw, and with over $1 trillion of US debt that has to be funded or sold in the third quarter to finance government borrowings. I mean, obviously we're seeing these official interventions. What fools! I mean, as an asset class, first-tier gold is increasingly competing against US Treasuries since Basel III made it a first-tier asset. This is absolute craziness. We should be listening to this.
We should. And to your point, if you go back to intervention in the markets, that was officially enshrined in law. I believe it was the Gold Act in the 30s in the U.S. where they created the Exchange Stabilization Fund. And if you read the legislation around that, they can intervene in any single market they want. And the original funding for that intervention came from all the gold confiscated when the president issued an executive order. So they've used gold to fund intervention into stock, bond, and dollar markets. So if they did that, why would they not use the gold sitting at Fort Knox or at the New York Fed to do the same thing? So do we have those 8,000 plus tons? I don't know. It hasn't been audited since the 50s, at least not publicly. So it's been almost 70 years since the U.S. has had a gold audit. So how do we know that it's not all gone or maybe leased out? And I don't know about you, Andrew, but if the gold's leased, I don't think the other party's giving it back. Given the current situation, they're like, I'll default and I'll keep that gold. I'm not giving you back and getting, fiat. Forget that. And with respect to China and Russia, I did a report here a few months ago. How much gold does China own? Well, if you look at the amount of gold produced, plus what they buy and what comes in and out of the Shanghai gold market and what goes to Hong Kong for jewelry, they only lost something like 54 tons last year. But there were thousands of tons that they either produced or took in. And if you add that up over time, since the Chinese basically have been, and the Chinese have been hoarding gold for a long time, we're talking decades. I estimate that the Chinese probably have at least 20,000 tons by themselves. And if you look at what happened with the sanctions on Russia, what Russia did when there were sanctions on them and the ruble began to crash, they said, okay, well, if you want our oil world, because we're one of the largest oil producers in the world and you can't survive without us, you have to pay us in rubles. What did that do? It rose the value of their ruble. But to prevent that from rising too fast, because when you switch from paying for oil in dollars to ruble not being reserve currency, it has a higher chance of hyperinflating, okay? Because it's not held as widely in foreign exchange as the dollar is. So the Russians had to do something to prevent their currency from blowing out, from getting too valuable, if you will, and having too much demand in a short time frame. So what did they do? They pegged it to gold. So in other words, the Russians are using the ruble to trade oil for gold. So what's happened to Russian gold reserves? It's shot up, right? They're trading black gold for the real stuff. Why? Because they're smart, because they know what's going to happen. What is the world doing in light of all this financial mess? All the central banks are buying gold. All the countries are buying gold. It's gold is what they're buying. And that's what's going to go up in value. And the currencies are going to come down in value. And, until, Andrew, we get to free markets again, and I don't know when that is, they're certainly not free now. If you want to talk about manipulation, you just look at the American market and, the COMEX, the commodities exchange, gold and silver, the most highly manipulated assets on that exchange. I can say the same for oil and sugar. If you look at the concentration in banks, 4 to 5 to 6 banks that hold these derivative positions in gold, silver, sugar, and oil, those are the 4 that get the most manipulated. Of course, you got platinum and palladium too. The commodities markets are manipulated. We don't even know what the real valuation should be. And I suspect that once the world challenges the US dollar and says you're no longer the world reserve currency, they're going to peg it to gold. And gold is going to shoot up in value. I think silver will shoot up right after that. It's a companion metal. The only reason, and I think silver will go up multiples of what gold is, but the only reasons I have a hard time seeing silver's money is because it's used so much in industry. We're in massive deficits. So yes, if you have silver, you're not only going to get that monetary bid, you're also going to get the industrial bid, because we've been in deficit for 4 straight years from the mine output to what we've got. And I'll add one last thing onto that. We're in an existing silver cliff where there's not enough mine to meet current demand right now. And you can see the stockpiles in London and the stockpiles in the US starting to be drained. But now we're seeing proven and probable reserves start to fall off a cliff for gold. And you've got population going up, and you got proven and probable reserves going down. So what is that going to do for gold from here on out? It's going to make it more valuable. We're going to have more demand and less supply, per capita, per person on Earth. And I think that's really going to drive the value of the precious metals.
What a perfect example. We see the ruble really weakening significantly with this intervention going on right now. Obviously, we've got a massive intervention. We've got a dollar trying to be propped up, and the ruble has declined. However, yet the more liquid Moscow, very liquid Moscow spot contract that competes with London is trading consistently, without exception, at a $2 to $3 premium to London. And the futures market, the Moscow futures market, is trading at no coincidence, at a $2 to $3 premium to December futures, COMEX December futures, only it's physically backed. And so as a result of this, now you can see, so what's gold done? Gold has done what it says on the box. It has completely protected them. But into all of this, Russia is accumulating physical gold. Why are they, literally, they are accumulating as much physical gold as they can. They're attracting this bullion in by paying a better price than London. And of course they are. And of course, so this situation is ludicrous when you think about it, that nobody pays attention to this. And in the meantime, what is the Fed doing? The intervention is causing them to sell gold. And as you say, because it's part of their mandate. And you know what? The funny thing is, Rob, is that I've had a lot of really good vests, and they're all correct. The Fed doesn't understand gold. It's not even on their radar. But there's one thing I now disagree with, is since the 1st of January, when Basel III NSFR standards turned gold into a first-tier asset, it got their attention. And what do you think they're doing now? It is competing against central banks and sovereigns. What we're talking about is them ditching treasuries for gold, for physical gold, taking one first-tier asset, which is bound to default. You've just outlined perfectly. One day, this has to default. There is no back door. Short of starting a nuclear war, this has to default. So, and assuming that no one wants a nuclear war, so what does it mean? It means that the Fed is the only central bank globally, and that includes the Bank of International Settlements, all of these other banks, every single bank, Russia, China, every other global central bank is positioned long gold, because they see gold and their gold revaluation accounts are there ready to be exercised should they need to. And what is the Fed doing? The only central bank globally selling paper gold into this situation. It's mind-boggling.
It really is. And, the paper gold trade really needs to end. It doesn't serve a purpose. When the commodities markets originally came out in the 70s here in the US, the purpose was legitimate hedging with some speculation to make the markets liquid. The explanation was you didn't want a straight hedging market because there may not be somebody to take the hedges, and you need to protect the farmers and the miners and the producers that use those products to make it easier for them to absorb seasonal changes in price, which certainly makes sense. But I mean, if you look at what the markets are now, a lot of physical delivery does not occur on those markets. It is just massive amounts of paper trading. And I do something called a weekly market wrap up every Friday on my channel. And I break it down every single week. We go over, gold and silver. What is a derivative trade? How is it affecting price? Why did this price move? What were the settlements? Who's doing it? What does the commitment of traders from the regulator, the CFTC, say? And it's blatantly obvious these markets are a gambler's market. It has nothing to do with the commodities. There is some control of commodity prices, but in terms of the physical, it's not that they're taking massive deliveries off these markets. They're controlling price. But not only that, they financialized it. If you add up like the options positions in addition to the futures, but here's where it gets really nasty. I did a study on the options a couple of times, and that's hard data to pull down. And it took me hours to get that pulled down and into a format that I could analyze the data. It's not friendly data. You can do it. But I took the options data down, and I could see price targets in gold and silver, both above and below. And I could tell you where the bullion banks are going to move that price depending on where their options expirations were. Why? Because they make a ton of money on options. What is an option? You use a little bit amount of money to control a big portion of trade. And if you happen to be on the money on that trade, you make a lot of money for a little investment. It's a very lucrative for big financial houses that can do this. And you could see them using the futures prices to move the price towards their options targets. At the end of the day, you can't say it's a coincidence when it happens over and over and over again. And when you consider the fact that companies like JP Morgan, I think there was a report out a couple of years ago that they had never lost on commodities trade in so many years, and they've made $1 billion. And it's like, okay, they're trading that market to make money. It's not about the underlying assets. And so these markets are just so perverted from what their original intent is. They don't serve the people. They're not fit for purpose for helping farmers and producers manage their input costs and their sales. It has nothing to do with that anymore. It's the banks that just run these markets to make money. And eventually that has to blow up because all the small people in the system eventually are going to go bankrupt because where does the money come? Where's JP Morgan getting their money from? It's everybody else. You've got the big banks and everybody else. And for them to get money, you have to take it from somewhere else. It's a zero-sum environment. My loss is your gain and vice versa. Okay? So they're basically taking money off of everyone else. It's a financialized market. Well, eventually that breaks when everyone else doesn't have any more money left.
This is the same bank that the Department of Justice labeled a criminal enterprise. And then we find, as you say, quite rightly, and I think we've had this data several times over the years, how as a statistician, how as an accountant, how is in your mind, how is it possible for any statistic to say you never lose money on a single day? That is surely just the red flag that says, yeah, this criminal enterprise is still functioning 100%, sanctioned by who?
Good question. The problem with the markets is you can't tell who owns what. I mean, you got these big, one comment I made on Twitter, I guess we're calling it Twitter, I don't know what it's called now, on social media the other day, we were talking about how this all worked, and I made the comment, the bullion banks are intermediaries, and they shield us from knowing who's doing what. So you could have sovereign, it could be China in here doing this. It could be the U.S. government for the exchange stabilization. It could be anybody, and certainly the banks make their money off of it. So the banks are serving on behalf of whom? Well, just look at who has a vested interest in the United States failing. That's every country who the United States has ever invaded, toppled, stolen resources from. I mean, it's the rest of the world. So, goodness gracious, there's every reason for those markets to be a big mess. And I'll be honest with you, Andrew, I don't think we're getting control of the markets before it crashes. I think it's got to crash first, and before we can ever have true markets again here in the US. And I hate to say it, but I think we're beyond the point of no return. If you look at Reinhardt and Rogoff, those Harvard researchers, I think Harvard, Stanford, who looked at debt and looked at the system, we're way past the point at which this is recoverable. It's all kabuki theater right now. It's all, the politicians getting votes and, people getting money where they can out of the system before it falls. But if you look at all the value, I mean, look at the pension funds. They're filled with crap right now. I'm sorry, if you have a pension in the US, you're not getting your value back. I mean, I hope that you're getting funds right now, because if it's more than 5 years in the future, you're probably going to get close to zero. Because what they do with the pension funds, they got rid of everything of value and they stuck a bunch of paper in it. Well, what's going to happen to that paper when this debt cascade comes? That's not going to be worth the paper it's printed on. You'd be lucky if you get 10% back on your money. And look at what's happening in the US to industry. Yellow, the third largest shipping carrier, the unions ran them out of business. The union bosses said, raise wages. Okay, they went bankrupt. Guess what? Months later, 30,000 employees in Yellow lost their jobs, but the fat cat union bosses walked away with their money. It's not about helping the people. It's about them getting theirs before the crash, and they know. And this is what's happening to UPS. Yesterday, it came out UPS is paying the average driver $170,000. Andrew, I had 2 degrees, a master's degree in cybersecurity. I didn't make $170,000 when I was in industry. I made a good living, but it sure as hell wasn't $170,000. And no disrespect to UPS drivers, but $170,000 to drive a truck? I mean, you work hard, sure, but when I worked manual labor jobs, when I was a kid, I made $3.35 an hour. Try living on that. The expectations of the union, it's going to bankrupt UPS. If UPS does not go bankrupt in the next 5 years, I will be absolutely shocked. And what you're seeing is people getting theirs. People know it's going down, and they're going, the unions are taking what they can. Everybody's taking what they can. It's a free-for-all system right now. The ties that bound us together as Americans are falling apart. You're starting to see the cultural and political ramifications from what happens when a group of bankers screw up the money supply and screw up the monetary unit of a society. Then society starts eating itself and fighting itself. And that's what we've got going on in the U.S. right now. And that's a shame. It really is a shame. U.S. was a great nation for many years, and it still has a great many people. But we're not what we used to be. The Constitution's not what it used to be. The money's not what it used to be. It's going to be painful living here in the next 20 years. I'm afraid to say it, but it is. And people need to pay attention to that. They need to understand. Your idiot politician who wants your vote's not going to tell you because you're not going to elect him. Most people want handouts now to elect politicians. They don't stand on issues. The Constitution is not even taught in the United States in the classrooms anymore. I just was talking to lawyers, and I won't divulge, I was talking to lawyers who said in the state of Texas, if you argue the Constitution, you can get thrown in jail for contempt of court. The Constitution is not the rule of law anymore. And where did it start? It started with the corruption of money. And then it started with the corruption of politics. And now it's a corruption of culture. And those 3 things go hand in hand. Sir John Glubb, in service to the Queen, did a report in 1971 called The Rise of Nations. I call it The Rise and Fall of Nations, where he looked at 11 major nation states dating back to the ancient Assyrians. And this happened to every one of them every single time without exception. It didn't matter what day and age or where on earth, those dominant civilizations went through the same steps. And once you get to the point of the corruption of the money supply, the whole thing falls down. And that's what's happening right now to America.
I think I want people to, I really hope people are taking note here, because this is about information. This is about information that you need to act on. Now, I really feel sorry for the people who cannot have not even the wherewithal to accumulate gold and silver. That is a very difficult thing. And I really feel sorry for them. But in the meantime, anyone who has the ability to exchange your depreciating dollars, other than what you need to go down to the store and buy your food, other than that, really need to be moving into your physical gold and silver and get it out the system. And really, that's what we're talking about here. There is a solution to this. And obviously, all hell's breaking loose at some point. Yeah, I mean, whether it's going to result in a nuclear war, because sometimes wars Wars are started exactly in these sorts of situations, and I do hope not. But that could blow back against the same guys who would actually prefer to pick up the pieces at a dime, at a penny as a stock that has crashed down to, a penny from God knows where, and which is what happened in the Great Depression previously. So, probably more that's what it will be. But goodness me, Rob, there's some education here. And I think you are an accountant. You are a forensic guy. You've looked at this. And I really think we should take note, because this is not supposition. This is this is an assessment based upon fact, and it's inevitable. And what you've just described from 1913 to now, it's come to a head. It's coming to a head, and we're very, very, very close. So, obviously, Rob, I'm going to join you on your platform shortly, but I want to thank you so very much for joining us here and really giving everyone's head a shake here. We all need to give our head a shake and say, you know what? Yeah, we're plodding along. We're watching the markets. We're watching manipulation here. We're watching them screw around with the paper price as we speak. It's not the important thing. The important thing is to use this against them. Use this to stack. Use this to swap those overinflated dollars for underpriced bullion. And I thank you for really drawing our attention to the bigger picture, Rob. And really, we need you to come more often and join us on the program. But thank you so much for joining us for this hour.
Yeah, I'm happy to, Andrew, and thank you for all the content that you put out. You guys have grown a wonderful channel and a wonderful following because you have such great guests and you have such great research as well. So we use that all the time, by the way, and we appreciate you guys for what you do. There really isn't enough people out there doing this, and I'm very democratic about this. We need more people talking about this. So congratulations on your success, and may your efforts be more fruitful in the future.
Likewise, my dear friend. Thank you very much.
All right. Thank you, Andrew Maguire and Robert Kientz, for another fascinating discussion. Now, remember, buy physical and make sure it's backed 1-to-1. Understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. So there you have it. That's all we have for you today on another episode of Live from the Vault. Please help spread the word about this channel by hitting that like button, share this information, and subscribe if you haven't already done so. Now, click on the bell right there if you'd like to be notified as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.